Good evening, everyone. Thanks for attending today's webinar and thanks Tiger Brokers for organizing it. My name is Grace Chu. I've been doing the sales and business development for direction in Asia for more than 10 years. I'm very happy to have this opportunity to share the 2024 big trading themes with everyone today, especially at this moment with earning releases, escalating geopolitical tension, uncertainty in the U.S. Fed monetary policy and the U.S. presidential election. And I hope the webinar today could provide more insights on your recent trading or investment strategies. So let's start the webinar right now. So these are some disclosures required by regulators. The webinar information today are for the education only and are not intended to be a sales or any marketing discussion under any circumstances. So before I jump into the topic today, I also want to give you some briefing introduction about direction. So probably if you have been trading leverage or inverse ETF in US market, maybe you are not, you will be familiar with Direction company because Direction is among the top two leverage or inverse ETF issuer in the world. So far we have 80 ETFs listed in US market, in New York Stock Exchange and NASDAQ. And of course, most of the ETF are 3 times leverage or 3 times inverse, which are short-term trading tools. So far, until end of last year, the total firm asset under management are over 38 billion. And we've seen a lot of, the fast AUM growth in Asia, and the growth, the fast growth is continuing. Before we jump into the big trading theme, I also want to highlight the basics and important characteristic of leverage and inverse ETF. Because as you know, although leverage inverse ETF are ETF, but there are big difference between leverage and inverse ETF and non-leverage ETF. I'd like to ensure everyone understands the difference between leverage inverse ETF and non-leverage ETF and how to use leverage and inverse ETF in a correct way. So leverage inverse ETF, of course, are also ETF, but they are more, they are daily based products. So leverage inverse ETF are daily based. For example, a daily 3 times leverage ETF is designed to provide 3 times of the index daily return, not 3 times of the index more than 1 day cumulative return. As you can see from the table here, the components inside leverage and inverse ETF in the world are similar. They are a combination of cash, equities, and derivative, typically swap or futures. Leverage inverse ETF listed in US usually use swap to generate the leverage ratio. Here are the most important 2 features of leverage and inverse ETF, which are daily rebalancing and implication of compounding. For example, what is daily rebalancing? For example, a 3 times leverage ETF. The daily rebalancing process is usually done at daily market closing time to ensure this 3 times leverage ETF tracks as closely as possible to 3 times of the benchmark's daily performance. We are leveraging up on up days and down on down days for the leverage ETF. This is the main cause of compounding. And I think the easy way to understand daily rebalancing is the ETF respond to gains by increasing the daily exposure to the index and respond the loss by decreasing the daily exposure each day. So this daily rebalancing causes compounding effect when calculating the total return more than 1 day. Therefore, trending market favors leverage or inverse ETF, which with daily reset and compounding that will amplify the long-term return. However, compounding effect of daily return works against long-term holding leverage or inverse ETF in a choppy market, which is very important. So let's take a look at the implication of compounding in a trending up market for a daily 3 times leverage ETF. As we can see, the benchmark index move in a direction favorable to the leverage ETF in a linear trend for a period greater than 1 day, like the example here. The benchmark index rises steadily in the past 5 days in a row, and this daily 3 times leverage ETF's total gain for the past 5 days is much higher than the cumulative index return multiplied by 3 times here, as you can see. This is because as the ETF net asset rise with the favorable market direction, the ETF must respond by increasing its exposure every day to the index and therefore amplifying the impact of favorable index movement. However, if the benchmark of the 3 times daily leverage ETF move in a direction unfavorable to the leverage ETF, meaning down market for the leverage ETF here, in a linear trend for a period longer than 1 day, this ETF loss for the period may be less than you expect, less than the cumulative index loss multiplied by 3 times here because of the daily compounding when the benchmark moving unfavorable to this ETF, we decrease the exposure every day at the end of the day. And however, in volatile markets, that shows no clear trend or no direction, the impact of daily reset or compounding definitely will bring some loss will be very harmful to the performance of leverage or inverse ETF over time, because increased exposure before a loss will generate a larger loss, and decrease the exposure in advance of the gain will decrease the potential total gain of the leverage ETF. So a continued pattern like this, as we can see, and definitely that will cause the decay of the long-term return of the ETF. In the table above, we can see, from this slide, an example of a leverage ETF that had a negative return after 6-day period of volatile yet cumulative flat index return. Now you understand why I keep emphasizing that leverage inverse ETF are designed for the short-term trading tool instead of traditional buy and hold long-term investment asset. So from this slide, I want to give you some summary. So therefore, it's very important to keep the guideline here when you consider to use leverage and inverse ETF. First of all, the performance of leverage or inverse ETF is based on the daily price performance of the underlying asset. Second of all, holding leverage or inverse ETF for the period longer than a day will be impacted by the effect of compounding for sure. Last, trending market favor leverage or inverse ETF with daily rebalancing and compounding that will amplify long-term return. However, the compounding effect of daily return works against holding leverage inverse ETF more than 1 day in the choppy market. So I think this is like 3 important guidelines you have to know before you trade leverage and inverse ETF. So leverage inverse ETF are definitely ETF. They are traded like stock, like equities, but they are not designed for long-term buy and hold investment. Remember, there are always core investment and satellite investment in your portfolio. And leverage or inverse ETF are categorized as satellite investment. And according to our survey, the average holding period for 3-time leverage or 3-time inverse ETF is about 3 to 5 days. And of course, you have to keep in mind that the higher the leverage ratio the ETF are, the shorten of the holding period, the shorter the holding periods will be. So I think that's very important when you are trading leverage inverse ETF, important guideline you have to know. So before we dive into the big trading theme, let's take a look at the market and see what are the significant catalysts for the market this year. So as you can see from this table, last year was a great year, especially for the stock market. U.S. technology and semiconductor sector were leading the overall stock rally. And as we can see from this table, U.S. stock continue to rise so far year to date. Technology, AI, and semiconductor sectors are still the leaders of stock market. And after the short-term rebound from last November to this January, as we can see, U.S. Treasury is still red year to date again as of April 10. So, but commodities such as gold and oil have seen significant rally this year. So this is the quick snapshot of the various key assets year to date. So from this slide, if we keep eyes close to the U.S. stock market, we will find the top 3 performing sector last year were information technology, communication service, and consumer discretionary. For these 3 sectors, the concentration risk is quite high, as you can see from these tables on the slide. Will the 3 sector winner continue to lead the rally this year? I think this is one of the mostly asked questions from the investor. So this year, definitely there are 4 key catalysts that we expect to dominate the global financial market. The first of is the potential Fed rate cut, U.S. presidential election year, AI development, and the last one is escalating geopolitical tension. As we can see from this slide, this chart, U.S. inflation is still sticky. Policy rate has been held steadily in around 5.25% to 5.5% range since last July. And the Fed chairman's remarks in May reflect a broad shift in thinking at the Fed to holding borrowing costs at the 2-decade high for longer. And that change in tune represented the combination of several months of firm increase in inflation, higher, inflation, hiring, and consumer spending that has also led the market and investor to pare back the bet from 6 rate cut this year to just 1 to 2 times rate cut. So if U.S. Fed will keep the interest rate higher for longer, investors definitely must want to know how the market performed during the whole period, which is during the period between the first Fed rate hike and the first rate cut. Probably we can learn from the history. As you can see, from the bar chart, in the past 5 Fed cycles since 1990, bonds have produced average annualized return of around 14.8% during the whole period. And stocks have also delivered very strong performance, outperforming both cash and bond in previous whole periods, as you can see from this bar chart here. And the history also shows markets tend to rally when rate high cycle ends. From this slide, we can see more performance details in equities and fixed income in terms of different regions, size, quality, or sector. As we can see from this bar chart, the left-hand side bar chart, U.S. stock market outperformed global market and emerging market. And mid-cap perform much better than large cap and small cap. For fixed income asset, emerging market bonds significantly outperform U.S. bond and global bond. And investment grade corporate bond perform better than high yield and U.S. Treasury. And from the table on the right-hand side, we can see sector performance 1 year after the last rate cycle ended from December 2018. Technology, finance, communication service are the top 3 winners here. I think the history may not repeat itself, but it might provide a very good reference for investors to position their investment directions in the future. And I think another key market catalyst this year is the U.S. presidential elections. From the history tell us that presidential election years have tended to be good for stock market. Since 1926, on average, the stock market have risen 11.6% during the election year, versus the market's average 10.3% return in all years. And the history also shows us the stock tend to follow a very interesting pattern during the presidential election year. As you can see, the first half of presidential election years tend to be sluggish, followed by a big second half. And the third quarter has delivered the strongest returns, with an average return about 6.2%, as you can see from this bar chart. And which sectors might perform better during the presidential election year? From this bar chart, we can see since 1976, the energy, communication service, and the financial sectors have been the top performers during presidential election years. Although there are so many issues that will play a big role in this 2024 election in terms of issues that align with market sector. Healthcare and energy sectors are important policy issues to monitor throughout the election process. And I think some investors definitely can keep eyes on the potential trading opportunities in these sectors I just mentioned, especially like healthcare and the energy policy definitely will be on the discussion between two parties of the U.S. presidential candidate. And this chart here breaks down the annual performance of the S&P 500 sector. Not only do you get an idea of how a small group of stock affects S&P each year, you can see how each sector performs through economic and stock market cycles. Sector performance definitely can change year to year. There's no sector is always the winner, no specific sector is always the loser. For example, as we can see, energy sector has a big swing, either the best or the worst. It used to be the top performance in 3 out of 10 years, and the worst performance in 6 out of the past 10 years. And for technology sector, as you can see, technology sector is always a reliable leader. It is the top performer in 2 out of the past 10 years, and is always in the top 50% of the sector in 9 out of the past 10 years. So looking forward this year, I think there are many catalysts for higher upside or downside volatility ahead, which might bring more market volatility, and the role of short-term trading tools such as leverage reverse ETF will definitely become more important for investors to capture the short-term potential market rally or hedge the downside market. At the end, I think I want to share with you some popular themes in terms of ETF tradings in the market. And here are some popular trading themes we've observed from an ETF issuer. I think the first is the U.S. Treasury yield trades, including U.S. Treasury golds or gold miners have been definitely been very popular, as this kind of asset classes are very sensitive to the U.S. Treasury yield move. And the second thing is AI and semiconductor are in spotlight. Semiconductor leverage ETF is one of the 10 mostly heavily traded ETF last year. And the third thing is the big technology, of course. Some big technology stocks have been rallying since last December, and the rally continues still. And all eyes definitely right now are on the big technology companies' earnings. And single stock leverage reverse ETF tracking Tesla, Apple, Amazon.com, etc. are hot trades for retail investors, as we can see. We also saw investors use Hong Kong or China ETF, leverage reverse ETF, to trade China or Chinese technology stocks volatility. And the last popular trade is oil and energy. So oil and energy sector have been under the spotlight due to the escalating geopolitical tension, and we believe the trend will go on this year. And next, I'm going to give you more detail about each potential trade. So U.S. Treasury yield move. When, of course, I mean, while most investors still expect 1 to 2 rate cut this year, and they see a growing need to hedge against a non-change scenario as solid U.S. inflation data push back the expected timetable. Actually, swap traders have quickly priced out the first rate cut to November from September, while some Wall Street strategists, including like Goldman Sachs, also reset their forecast on the first time rate cut timetable. So with the increasing volatility of U.S. Treasury, investors actually could use, for example, inverse ETF tracking U.S. Treasury index to hedge the fixed income portfolio if the U.S. Treasury price suddenly plunge a lot, or use leverage ETF, the bull ETF tracking U.S. Treasury to catch the potential short-term bond price rally when the strong rate cut expectation come back again. So this kind of leverage reverse ETF tracking U.S. Treasury index have been very popular, and we've seen a lot of trades since last year. And the next thing is definitely, as I mentioned before, is gold and gold miners. So definitely this year, March 2024 has been a golden month for gold mining stocks, making their best performance in the past 1 year. And the catalyst was a mix of anticipation for lower interest rate or robust demand from central banks sent gold price soaring. And gold price and gold miners have very high positive correlation, as you can see from this chart. I show the gold price movement and the NYSE, ARCA gold miners sector index. As you can see, gold price just move aligned with the gold miner sector index. And gold miner equity usually have a higher volatility than gold price movement. So many traders or high frequency trading investors actually prefer to trade gold mining sector leverage reverse ETF for a momentum trade to amplify, their potential short-term return in, a return when the gold price is very volatile or the gold price have potential like upside or downside. And here the third theme is biotech. So biotech is another popular trade in terms of ETF trading. There are some trading catalysts for biotech in this year for sure. For example, this sector is expected to see more discussion due to the US presidential elections and the more M&A activity this year as the market expects. And the use of AI in biotech is growing, and weight loss drug have created a frenzy and may continue to be a boom for this space. However, as you can see from this chart, biotech sector is a very volatile sector, as you can see. And this chart, this is the move of S&P Biotechnology Industry Index. Therefore, if you want to trade biotech, especially leverage inverse ETF on biotechnology sector, definitely the timing matters when you want to trade the biotech swing. This also shows why biotechnology leverage inverse ETF are very popular for traders to do the volatility trade or momentum trade, because this sector is categorized as high volatility. And energy sector definitely is one of the key policy issues to monitor throughout the US presidential election process. And US energy sector has seen more buy rating from the bank's analysts this year. Also the escalating geopolitical tensions in Middle East also put oil and energy sectors in spotlight here. So instead of trading all your futures or ETF tracking all your futures contracts, actually many investors also look for energy sector ETF or energy sector leverage reverse ETF, because this energy sector ETF also have very high correlation with the oil future price. But energy sector ETF don't have the monthly future rollover or contango issues, as the energy sector ETF, their tracking index, the tracking index components are energy company equities, definitely not all your futures contract. So this is some alternative for people who want to trade oil related, but don't want to trade all your futures directly or all your futures ETF directly. Energy sector definitely is the kind of good alternative for you to consider. And technology sector has been one of the top performer in stock market. It is also the largest sector in S&P with 30% weightings, market weightings. And the rally of technology continue this year because AI plays a very important role in this sector, as you can see. And also with the outstanding rally in technology sector, I think many investors here definitely start to question whether it is a tech bubble right now. So I think probably there is no tech bubble because there's some reasons, to explain the significant rally in technology sectors since from last November until now. Because although technologies, because let's take a look at the valuation. So although technology's relative performance has indeed been extreme compared to other sector, and the valuation, like the PE ratio, price earnings ratio for technology sector, don't seem to be at extreme If you remember, at the peak of the tech bubbles, this sector traded at a forward PE ratio of almost 60 times. Right now, not the PE ratio of technology is at, is at only about half of that level. Right now, the PE ratio is about like 30 times right now. Besides, technology sector has been buoyed by near record profit margins and rising earnings growth forecast, which could also indicate this sector might still has more rooms to run. And here is one of the representative technology sector index, which is S&P Technology Sector Index. As you can see, the price has been at a high level for a while, and actually there's no obvious breakthrough. And in April, we did see the pullback in technology stock. So I think at this moment, this point, it is better to be cautious at technology sector as the short-term drawback is possible. Especially when technology sector is at this a high level valuation compared to other sectors. So if you want to concentrate on only magnificent 7 stock, this index INDXX front of Q index definitely is a good index for you to refer to. As you can see from this chart, I compare this the front of Q index with Nasdaq 100 index. As you can see, year to date, the rally from technology sector is purely led by a few of mega technology companies. As you can see, the white line, which is the INDXX front of the Q index, and the yellow line is the Nasdaq 100 index. Year to date, the Magnificent 7 index definitely also outperform notably over Nasdaq 100. So this index is designed to track the performance of the 7 largest Nasdaq listed companies. The current 7 holdings are Apple, Microsoft, Alphabet, Amazon.com, Nvidia, Tesla, and Meta. I think everyone is so familiar to these 7 stocks. Each stock is equally weighted. You can find the corresponding ETF or corresponding leverage reverse ETF tracking this index in the market to trade the volatility of Magnificent 7. And here, I think the outlook for AI-related or semiconductor stock earnings, remain very positive. There are 3 trading catalysts for AI-related stocks. The first is broadening demand trends on AI. And the second is the new revolutionary products. And the third one is the increasing adoption of AI across to more sectors, not just in technology sector. And this industry, semiconductor industry, as you know, has a long history of being very volatile and very prone to busts, and also very susceptible to high valuation, as you can see from this chart on this slide. And this chart, I show the price move of ICE semiconductor sector index. So this high volatility features of leverage of semiconductor sector also make it the most popular trade in terms of leverage and inverse ETF. As I mentioned, the semiconductor leverage ETF is among the top 10 most traded ETF last year. So using semiconductor leverage inverse ETF for opportunity trade or momentum trade is pretty popular for traders, as we can see as leverage or inverse ETF issuer. This kind of ETF have been very popular, especially in Asia market, at least in the past 3 or 4 years. I think the last thing is Hong Kong and China. So we also observe many investors see China and Chinese technology company as potential opportunity trade or direction bets for the bottom fishing this year. The lower valuation of Chinese stock versus development market such as US stock market. Actually Chinese stock or Hong Kong stock is really attracting global investors to diversify their investment in this market this year. So I remember I just saw the data. So and until end of this April, I think China market has been attracting the global fund by the global fund cashing in 3 months in a row, which is the longest stretch in the past 1 year. So also which shows that because of low valuation and still the stable economy of China still continue to attract the global fund due to the low valuation right now. So here, as we can see from this slide, Fuji China 50 index is one of the representative China index in the world, which is composed of the largest 50 Chinese stock listed in Hong Kong Stock Exchange, including some big companies such as Alibaba, Tencent, Meituan, JD.com, etc. So with the big swing of Fuji China 50 index, as you can see from this chart, the leverage of inverse ETF tracking this index also attract many traders to do the short-term volatility trade or momentum trades in the market. So I think at the end, here I summarize the trading themes I mentioned with their corresponding indices for your reference here. For example, S&P 500 track the big blue chip stock. Russell 2000 track US small cap. Of course, CSI 300 tracks China market, as everyone knows. So here are some representative like the the market or regional index. And here are the list of representative and the famous sector indices for your reference. You can find corresponding ETF or leverage reverse ETF tracking this index on TigerBrokersNZ platform. So as I mentioned, like a US Treasury, the US Treasury yield move thing, these two index actually since last year, a lot of trader or investor have been trading some ETF or leverage reverse ETF tracking these two index. And also like a gold or gold miner is also the big and the popular trades in the first quarter this year. Energy, there are definitely there are some famous energy sector index here. And for technology, of course, S&P technology sector or like ICE semiconductor index, they are like the big index. And also the ETF tracking this index also attract a lot of tradings. And like in the market, there are also China Overseas Internet Index. And this index also has corresponding non-leverage ETF or leverage ETF. So if you want to trade like a China overseas internet theme, definitely you also can find the corresponding ETF to trade in US market as well. So here, the last page, here are the most popular US stock that single stock ETF are trading right now, especially single stock ETF trading Tesla and NVIDIA are the most popular trade in terms of single stock ETF trading in US market. And you can find all these single stock ETF tracking this stock in US market to trade as well. And that bring us to the end of the webinar. I sincerely appreciate your participation tonight. Thank you very much, and have a good evening.